All right, why don't we go ahead and get started? So thank you guys very much for joining. My name is Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. We're going to talk about some steps you can take as you transition into retirement today. But first, we need to go through our various housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you get a copy of our FAP from our website, morningstar.com.au, and you should go talk to a financial advisor if you want personal advice. So as Mabel pointed out, she said, you're in a different room today, and that is true. So Will is on leave, I guess. He's working up in Brisbane. Will bought an investment property, and he's getting it redone before he puts it on the rental market. So he's up there supervising the tradies. So he set up a camera in a room. So that's where our team normally sits. So that is Emily. If you see the woman sitting, there she is, she's raising her hand. And if I move a little bit this way, that is Shawnee. She's sort of behind the light. She's waving as well. So anyway, yes, we are in a different room, but we're going to talk about retirement and the transition to retirement. So a couple of things. We will touch on what we talked about during the last webinar we did. So that time we were talking more from a portfolio perspective. Today we'll talk a little bit more from a planning perspective, but we can touch on some of those points. Also, ask any questions you may have. So if you have any questions, send those through. So let's get started. All right, so we're gonna go through three different things today, two of them kind of together. First two steps is obviously as you're transitioning and beginning that transition into retirement, there are a couple of things that are pretty important. You need to know how much you need, how much money that your portfolio or other sources of income need to provide you in order to retire. That is the first thing you need to do. The other thing you need to do, of course, is figure out what your withdrawal rate is, because your withdrawal rate is going to allow you to come up with that target for your portfolio. And then particularly if you're transitioning to retirement using super, there are a couple important things that you need to know to hopefully try to minimize your taxes and make that transition as easy as possible. So those are the different things that we are going to explore today. And we'll touch on a couple of the topics that we talked about last time, where we talked about transitioning your portfolio into retirement. So once again, I'm going to touch on two things that we talk about a lot. We're going to talk about sequencing risk, and then we're going to talk about longevity risk. Now, both of those are important to think about given the current environment we're in. So obviously, as people are well aware, market is not done very well today. There's a lot of people, I'd say myself included, they're a little bit worried about where things are going to go from here. So it is important to put that within context. If you are in that transition to retirement phase, there's a couple things that you should think about. So we'll try to include those as well, but certainly send through any questions you may have. All right, so as I just alluded to, when we're planning for retirement, when we're trying to figure out where we want to be at retirement, and this can be done at any age, but certainly is really critical to do as you sort of start getting into that phase where retirement is in the near future, mostly because this estimate can be a little more accurate. The two inputs you need is you need a salary replacement rate and you need a safe withdrawal rate. So let's talk about both of those. So we'll start with salary replacement rate. So very simply, as people are aware, you generally go from an environment where you were getting a paycheck every fortnight or every month to an environment where all of a sudden your portfolio is now paying for your life. And that transition can be very difficult to make for people because you've obviously spent your entire life working and saving for retirement, and now you've actually made it. So how do we figure out how much money we need to support our lifestyle in retirement? Well, one way to do is obviously you can build up a bottom-up budget of every single item in there, but that's difficult to do. So an easier way to do this is to start with your salary replacement rate and then potentially make adjustments depending upon your own personal circumstances and situations. So a replacement rate simply refers to the percentage of your salary that you need to replace in retirement. So you need to replace that either through money you take out of your super, you need to replace it from other sources of income, like perhaps an age pension or annuities that you have. You need to figure out some way, or rental property you have that potentially you are renting out, but you need to replace it somehow. But let's start with not how we're going to replace it. Let's start with what we need to replace. Now, there's a couple things that are important. A lot of people, I think, reflexively go back and say, okay, I need to replace my entire income if I want to continue living the same standards of living. Well, okay, that's not necessarily true, because we need to think about our salary and what comes out of it that will not be coming out of it in retirement. So we're going to talk about super and taxes a little bit later. But first of all, you generally will pay a lot less in tax in retirement, potentially nothing in tax in retirement, depending upon your financial situation. You also do not have to save for retirement when you're in retirement. So very simply, the first thing we can start looking at is the replacement rate based on removing these two things. Once again, these are based on your own personal circumstances, but removing tax you pay and removing the super you pay. So very simple example, we look at the average yearly salary for an Australian that is 55 and older, it is $71,417. So I'm just using that as an example. And obviously, your tax situation, which we'll talk about, could be very different depending upon your salary and where you are. But if we take that $71,000 and we plug this into Shawnee's favorite thing, paycalculator.com, it will tell us how much we're paying in taxes. So in this case, $11,600 in taxes, and then how much we're paying in super. I guess that super should be slightly higher now that we have upped the mandatory contribution to super. But anyway, you get the point. So what that means is a replacement rate of around 74%. So what this means is that to maintain the same standard of living, assuming you are not paying taxes that come out of your super, and we'll get to that, you would have to replace 74% of your salary. So that is something paycalculator.com.au. So Sean here's sent that in because it is her favorite thing. All right. So let's think of a couple of the considerations, because obviously what we're doing is we're looking at the average salary of an Australian above 55 years. Let's think about some of the things that we need to consider. So number one, we of course have a progressive marginal tax in this country. So what does that mean? It means that as we make more money, we pay more taxes on that money. So the interesting thing about that is that, in fact, the more money you make, perhaps the lower replacement rate you actually have, because of course you will be paying more taxes. So we can see right now, we went through our example here with the 74.1% replacement rate. Well, if I up that salary to $100,000, all of a sudden we have a 70% replacement rate. If I up it to $150,000, we have a 65% replacement rate. So I guess the good thing about this is that as you make more money, of course, you're going to need more in retirement. You're going to need more in your portfolio to support you, but you do get a little bit of a benefit because that replacement rate actually goes down. So that's one thing that we should think about. The other thing that we should think about, of course, is I'm looking at mandatory contributions to super here, but you can also save money outside of super. You can save more money into super, right? You can go into some of those concessional contributions. So what does that mean? It means that the more money you save, once again, the lower your replacement rate will be. So we've done the same thing. You can see we've added in some savings in here. So 5% savings, we've added 10% savings. So what we're seeing once again is that replacement rate going down. So of course, the assumption here is obviously you are not saving any money in retirement, but the more you save, the more you contribute to super, or just save outside of super, however you save, all of a sudden that will adjust your replacement rate as well. So just a couple different factors to think about as you're starting to think about sort of what that replacement will be. That replacement rate will be. The other thing, of course, where we get into withdrawal rate is you have to consider your lifestyle. So many people, of course, choose to make changes in their lifestyle, some of which make things cheaper. So potentially you would move to a lower cost location. Potentially you would downsize your house in your current location or potentially do both. So downsize your house and move to a place where real estate is less expensive. So that's one consideration. Another consideration, of course, is any expenses associated with work. So that could perhaps be your commute into work that you won't have to do anymore. But it's also really important to note that a lot of people actually spend more money when they just go into retirement because they're doing things like travel. Now, over time, typically that will go down. And then perhaps your spending could accelerate at the end again as you pay for medical expenses and then the life care. But think about that. Think about the lifestyle you want to live. So what that is going to be is, of course, adjustments. So you can kind of make those top line adjustments on that replacement rate to try to figure out where you want to be. So you could build in a little bit of a buffer, perhaps. If you are planning on traveling more, for example, and that's more expensive. A lot of people, of course, when they're not going to work every day, they tend to spend more money because potentially they're going out for meals or going out and doing different activities that cost money. So something to think about. But if we start with the replacement rate, it's just a really good place for us to then make those adjustments rather than trying to build out a budget from kind of zero up. But something to consider at the end of this replacement rate. All right, the next thing we need to talk about is a withdrawal rate. So very simply, what we're trying to do here is trying to come up with a portfolio amount that we need to support ourselves in retirement. And very simply, from a mathematical perspective, what we're trying to do is figure out that number, right? And so the replacement rate will then give us this number, how much we need every year. So that's what this bottom line is here, right? The total, it is how much we need to support ourselves in retirement each year. And then mathematically, all we do is we divide that by the withdrawal rate. Now, the withdrawal rate represents how much you're going to take out of your portfolio every year. So the higher the withdrawal rate, the more you're taking out of your portfolio every year. Of course, the lower that portfolio value is going to be to support the same income. The lower that withdrawal rate is, the higher the portfolio value is. You can just screw around with this in the calculator, right? Take any number, take $50,000 and just divide it by 4%, divide it by 6%, divide it by 2%. You'll see that it can make pretty profound differences in your portfolio. So that's mathematically what we're trying to do here. Let's talk about this safe withdrawal rate. So as I mentioned before, a lot of things that we're trying to do with transitioning our portfolio, if we're just looking at the assets held in our portfolio, a lot of things we're trying to do as we approach retirement is we're trying to combat these two twin risks. So longevity risk and sequencing risk. So longevity risk is pretty simple. And we talked about this last week. So you can go back and certainly watch that if you missed it. But longevity risk is pretty simple. You don't know when you're going to die, right? And that's a huge problem, right? It is, it's like planning a dinner party if you have no idea what time people are going to show up, right? So it makes things a lot trickier. And that's the problem we have, that we don't know when we're going to die. So if we knew when we were going to die, it'd be pretty easy to plan out your retirement, right? So we've got longevity risk. And the risk, of course, by not knowing when we're going to die is that we run out of money before we die, which we do not want. Second thing you're facing, and this is really important with the current environment, is you're facing sequencing risk. So basically, it's not just the average return you get over a period of time, it's also the sequence of those returns that matter. Basically, what we don't want is we don't want the market to fall significantly right before we retire and sort of into that retirement. So that's why we're a little worried about this right now. That if you're approaching retirement right now, you can be worried about some of the volatility that we're seeing in the market, where even though it is unnerving, if you're 20 years away from retirement, it's not as big of a concern. So the reason for this, of course, is that, you know, in investing, of course, if we have a very long-term perspective, we have time to make up those losses that we have. We are about to retire, meaning we are about to start taking money out of our portfolio, then we don't have time to make that up, because when the markets inevitably go back up, as they always have, so when they go back up, you'll have less money in your account to take advantage of those upswings. Whereas somebody that was much younger would not only not be taking money out of their portfolio, they'd be continuing to contribute during those down markets. So there's a lot more money in that portfolio that can take advantage of positive returns that come later. So how do we combat this? And once again, this was going back to that last webinar we did, is generally what we do is we worry then about the volatility of our portfolio. We think about how do we lower that volatility in our portfolio, lower the chance that it's going to drop significantly. And we do that by moving into defensive assets. So that's what we talked about in the last one. But once we've hit retirement and we have a certain amount of money, the biggest concern, of course, is, okay, how long will that money last? And that's why we're worried about that withdrawal rate, right? So the right withdrawal rate will allow you to support a lifestyle that you're willing to live while making sure that you don't run out of money in retirement during a period that you do not know how long it's going to last. So that's why the withdrawal rate is really important. So got to talk a little bit about the 4% rule. Now, before I get the question, because I always get the question, is yes, I understand that there are mandatory withdrawals from super, depending upon your age, that can exceed 4%. That is government policy to try to get money out of a tax-free, in many cases, or at the very least, reduced tax environment. And that is very different than setting a withdrawal rate that is going to allow you to not outlive your money. So I do want to say that in the beginning. The other thing I want to say is just because the government makes you take money out of super does not mean you need to spend it. What I'm talking about here is what you're spending. So yes, you can withdraw money from super and then you can just invest it outside of super or save it in a cash account outside of super. You can do all sorts of things. Talking about what you're going to spend. So just a little caveat. All right, the 4% rule is one of the most famous rules in investing, and I talk about it a lot on here. And at the end of the day, what this was is a financial planner named Bill Bengen in the US in the early 90s sat around and had client after client, of course, coming to him asking, how much money can I take out of my portfolio? And he said, all right, well, I should come up with sort of a rule for this. And that's where the 4% rule was born. So Bill Bengen, of course, knew about these two risks. This is not a unique thing, longevity risk and sequencing risk. And so what he did is he went back and he looked at market returns. Now, originally, what he did and what the 4% rule is based on is a couple things. Number one, US market returns. So we only looked at US shares and US bonds. And he looked at retirees that have a 60-40 portfolio. So what that means is 60% in equities and 40% in fixed interest. And we'll hit each one of those points. He looked at a very specific period of time because he was doing this, I think in 1994, he had to use the data he had. So he went from 1926, because you can get pretty good data from 1926, looking at US markets, to 1992. Because of course he couldn't do, the last 30 years that we've experienced because they had not existed yet. The other thing that happened is he adjusted those withdrawals for inflation. So what this means is, and inflation is obviously in the news a lot, what this means as a retiree is that 4%, the amount that you're taking out from your portfolio, allows you to maintain a real, which means we're including inflation, standard of living. So as inflation increases, and the way the 4% rule works is, let's say you're taking out $10,000 a year, and you have, what did Phil Blow say, 7% inflation by the end of the year? Well, if inflation is increasing by 7%, then the next year you take out $10,000 plus an additional 7%. As inflation falls, you'll reduce that. So that is the 4% rule. The other hugely important caveat, he ran all these simulations. So he ran all these simulations based on all of these different factors that I have in here to see how long the money would last. And his goal was to make sure retirement lasted for 30 years. So because he doesn't know when anyone's going to die, and nobody knows when they're going to die, he thought, okay, well, so the average person retires at, let's say, 65, and we add 30 years from that, that's going to be most people. Most people will be dead by 95. Now, just be very careful that this is only 30 years, all right? There is that tail risk that you're one of these people that lives to 105. So you always have that consideration. So remember, those are the rules around the 4% rule. The other thing that's important to point out is that a lot of people that are in the FIRE movement, this financial independence, retire early movement, they use the 4% rule by saying anytime you hit an amount of money in your portfolio where you can support yourself on 4%, whether that's at 25 or whether that's at 85. Anytime you hit that, you can retire. Well, that's not what the rule is designed around, right? It's designed around 30 years. So if you're retiring at 30 because you believe in this FIRE movement, well, that's a great goal, but you better hope you die before you're 60, right? All right, so that's what he did. He ran this thing called a Monte Carlo simulation, which is basically taking every combination of stock and bond returns applied to that 60-40 portfolio and saw when money would run out. Basically found out that in any market condition, any sequence of returns, so if you had the worst luck ever, that they combined the worst returns ever between 1926 and 1992, then you would still be able to survive for 30 years. So good question, Grant. We will get to that. So Grant asks, how is the 4% rule since 1992 to now? So I will answer that in 1 second. So a couple things that we need to think about here that Grant pointed out, one of them, when we're looking at the 4% rule. So the first thing, of course, is that market conditions have changed pretty significantly since 1992. And they basically all been positive at the end of the day. So what we've seen is certainly, we've seen returns accelerate, and we've certainly seen that happen in the past, till this year, in the past sort of 11 years or so. There was obviously that little COVID dip, but things still went pretty well. I will say, if you look at the decade between the year 2000 and 2009, things did not go very well. So like in the US, for example, the S&P 500 is actually negative that decade. But we've had such an acceleration of returns basically since the GFC, including that COVID dip, really until we got to January of this year, that the 4% rule performed just fine. But there are a couple changes that we should talk about. So number one, 60-40 portfolio. And there's a lot of arguments around the 60-40 portfolio. Many people say that it's antiquated. There was an article on First Links, I think 2 weeks ago, where Vanguard came out, someone from Vanguard came out and argued that no, in fact, it's not antiquated. But many people sit there and think of putting 40% of their portfolio into fixed interest and think that's crazy in this environment, right? And so if we think about fixed interest, now we'll talk about what happened this year. But coming into 2022, a couple things. Interest rates are really low. And so you were getting almost no interest on any bonds that you had because interest rates are so low. And also, of course, bonds prices move inversely to interest rates. So meaning if interest rates go down, that's really good for you if you hold bonds because the value will go up. Now, a lot of people sat there, myself included, and said, looking at this market environment, how are interest rates going to go down? They're so low that there's really nowhere for them to go. And I'm not getting paid any interest for holding bonds. So a lot of people just said, and it's this notion of TINA, there is no alternative. A lot of people said, why am I even holding bonds? There's no point in doing it. The other thing that made people recently doubt the 60-40 portfolio is shares have not done well this year, but bonds have done horrible as well. So obviously what we've seen is as central banks have started raising interest rates, and as the market has anticipated higher interest rates into the future, what we've seen, of course, is we've seen bonds crater in price. And so a lot of people, I think, have this notion in their head that shares and bonds move in the opposite direction. And the whole point of having bonds in your portfolio is because if shares go down, bonds will go up. Well, that's not true, right? So, I think what has happened this year, and I will say that, it's a little bit of an anomaly, but it does happen from time to time. We've seen both go down. And so a lot of people think, okay, well, I'm not getting that diversification benefit by being in bonds. So, just the couple of things I would think about there are bonds have gone down less than shares. So they are still less volatile than shares. So holding bonds in your portfolio would make your portfolio less volatile, still lost money in them. And also there are ways to obviously not have that volatility from bonds is by going for very short duration bonds, so bonds that do not, that will mature relatively shortly. So they have less of a price movement when interest rates go up and down, or of course, cash, right? Nobody wants to hold cash, but cash does have the nice thing of not being volatile at all. It doesn't bounce around in price at all. So that really lowers the volatility of your portfolio. Of course, you don't get paid anything for cash right now. And of course, if we look at an inflation adjusted basis, you are losing money in cash. Anyway, just something to think about. All right, so that's the 4% rule. So how's it performed since then, Grant? It's performed pretty well. But we'll talk about sort of problems with potentially the future for it. One other thing that I wanted to look at is that we, of course, ASFA has this estimate for how much Australians need to live a quote unquote comfortable and quote unquote modest lifestyle. And I just wanted to point this out because at the end of the day, and I'll sort of walk through here, you can see what we're getting for a year out of income out of our portfolio, what the portfolio value is. This is for comfortable, this is for moderate. Now, retirement, of course, everyone's retirement is different. Everyone has different needs. So some people may look at that and say, okay, well, that seems pretty good. Some people may look at that and say, that's a joke. I can't live on that. So of course it depends, but a couple things. Number one, both of these, couple of the assumptions in here should be supported with an age pension. So that's one thing. The other thing is it assumes that you own your house outright. So, for some people, that's absolutely their reality. For some people, that is probably an unattainable dream, but just those are the two assumptions that go in there. And if you actually look at the math here, when we look at the age pension, when we add the age pension to this annual income need, we're at about 4%. In terms of a withdrawal. So, it's this rule did not come from nowhere. All right. So what are some of the problems before we get into super? Let's talk about some of the problems with the 4% rule. And so Morningstar actually came out with a report kind of in the middle of last year, or maybe sort of getting into the spring, came out with a report that was re-examining the 4% rule. And it was looking at a couple of the things that Bill Bengen originally looked at and said, okay, well, what if we tweak things a little bit? Now, what Bill Bengen used is he used historic returns. And as we see in every single advertisement for any sort of investment product, you get that same disclaimer, right? That basically the future may not resemble the past. And that, of course, is true. So what we looked at when we were going back and doing this examination, we're going to do this once a year. So we'll do it sort of the same time period. So probably in the next couple of months, it'll come out. We went back and we said, okay, well, we have forward assumptions for what we believe different asset classes will achieve. And they're on our website, Morningstar Investor. They're in our new IPS. Which is our investor policy statement. I can show you guys where they are. But we have forward assumptions at Morningstar for what we think the returns will be on different asset classes. And one of the really big inputs into those assumptions, of course, is where we are right now. So what we need to remember is that, as we sort of have harped on our podcast, is that the level of valuations that we had in markets at the end of last year were literally the second highest they've ever been in history. So if you go back and look at like a CAPE ratio, for example, so cyclically adjusted price to earnings ratio, which is looking at a PE ratio that we always hear about, but what it's also doing is it's trying to take out the cyclicality of earnings. So it's trying to look over a 10-year period and smooth out those fluctuations we have in earnings from companies as they go through the business cycle. So we look at the CAPE ratio, it was the second highest that it had ever been, only dwarfed by the dot-com bubble. Pretty much every other valuation measure, whether you're looking at just a regular price earnings ratio, whether you're looking at dividend yields, one of the most expensive markets in history. Higher the valuation level, the lower expected future returns are. Same thing with bonds, as I was talking about. We're looking at interest rate levels. We're looking at the amount of interest you're, of course, going to get from those bonds and those projected forward returns and the projected forward returns that we have on our website, where we're just publishing them. Those are all significantly below what they had been historically. And so this should make sense, right? Since the GFC, we had returns that were, of course, above average. So how do we get back to average? We have to have returns that are below average. So we re-examined that 4% rule and ran the same simulation, but instead of running the simulation on returns that had previously occurred, we ran them on what we think they'll be out into the future. And unsurprisingly, given everything that I just said, we estimated that the new 4% rule, if Bill Bengen had done the study given the data that we had, the new 4% rule would be 3.3%. So people know, of course, that is lower. That means you need more in your portfolio. And so we did a series of webinars talking about this. Shani wrote this incredible guide that if anyone would like a copy of, just email me, sort of going through this. And there was a lot else that went into this study. So I was looking at a couple of things around fixed versus variable withdrawal rate. So fixed withdrawal rate means that every year I'm taking the same amount of money out of my portfolio, just adjusted by inflation, so called fixed real withdrawal rate. Then we looked at flexible withdrawal rate, saying, okay, well, maybe I will adjust how much I take out of my portfolio based on how the market is doing. So moving to a flexible withdrawal rate, of course, that gets that withdrawal rate back up, right? So that's something, a flexible withdrawal rate is something that will make your money last longer. So we looked at all these different scenarios. So the report has a lot of stuff in it. And so if anyone wants a copy of that or the webinar we did previously, shoot me an email and we can talk about that. Now, since, of course, that happened, so since this report came out, we have seen markets fall and we have seen bond yields go up. Now, that hasn't been good for people's portfolios, but it has lowered, of course, those valuation levels. It's made bonds a little more appetizing because now you're getting more yield on them. So I'll be interested to see sort of where we come out with the study this year. But a point that, sort of I've tried to make a lot, and that Shani and I have tried to make on the podcast a lot, is yes, valuation levels have fallen, but we're at about average. So if we go back, that same CAPE ratio we're looking at, we go back and we look at from the year 2000 on. So we're not even going to go back, like, if you go and look at the data that goes into this CAPE ratio, which is just on a Yale University website, if you go back and look at that data, the data goes back to the late 1800s. If we just look at sort of, I won't even call it the modern era, if we just look at this millennium and go back to 2000, we're at about average. So the market's not cheap in any way, but because those valuation levels fell, my assumption is, of course, that we are going to get that 3.3%. It will go up this year. I wouldn't think till 4%, but anyway, we'll wait for the report. So we have a couple of questions where we get into super. Okay, so Ross is asking, could the numbers in the table be explained? Why is both single and couple both $70,000? Because what they're basically saying here is that to get a moderate retirement, you're getting most of your money from the age pension. Right. So if you sit here and think about this, like look at these numbers. So we sit there and we say, all right, so to have a moderate retirement as a couple, $41,170 a year is your income need. You're not getting any of that from your portfolio. Right. So, when we max out the age pension, we get $34,000 a year for the age pension, right? So that's making up a huge percentage of that. So sort of the assumption is you don't really have any money in your portfolio. So I think what they're trying to sit there and say is, okay, well, you can live fairly comfortably off the age pension. And that's obviously up to each one of you on your own circumstances and how you think you can live. So hopefully that helped, Ross. So that stuff, I just took that off of ASFA's website. All right, so Phil says that I checked my super balance yesterday. It's quite sobering. I switched last September to a mix of balance, fixed interest and cash. That's where I learned that cash saved the day. Sort your risk is really important. If you're like me, 5 years out from retirement. Yeah, no, absolutely. So obviously, I think that there are a lot of people that have been looking at account balances and probably received I guess shocking news given what has happened. But yeah, I think it's really important that is why as we approach retirement And this is sort of that portfolio transition we're talking about. We need to find ways to remove that volatility in your portfolio. And what we talked about in that last session, we talked about some of the techniques that you can actually do this with. So we talked about the bucket method, for example, which is a way to remove some of that volatility risk, that sequencing risk in your portfolio. Yeah, so the two numbers, what the two numbers are, this first number, the smaller number right here, Robert, that is how much income you need a year to support yourself in a comfortable or moderate retirement. So once again, you can argue with that as much as you want. And then that's the amount in your portfolio right there. So what they're basically saying to you is that it's a lot easier if you're in a couple. But that's what we're talking about. So we can certainly get back to this stuff, but I did want to talk about a couple other things that we should start thinking about as we are approaching retirement. So one is, of course, super. And what is your plan? What is your transition to retirement plan? So we want to walk through a couple of examples of different things that people do. First of all, this is a nice little diagram, but I'll go to this one. So I know there's a lot of words on here, but I did write out an example. All right. So looking at a transition to retirement account. So I don't know how many people are aware of these, probably most people that are on here, but this is a potential way to lower your taxes as you transition into retirement. So I think, as some people know, there's an accumulation account. Your accumulation account, of course, over the life of your super, that is your super, right? So at the end of the day, what are you doing? You're working, you're saving money, you're accumulating it into an account where you are investing, and you're trying to accumulate, I'll just keep using that word, enough money so that when you hit retirement, you can pay for it. But as we start approaching retirement, we can look at different ways that we can start to hopefully save some taxes and potentially build up our super balance as well. So one thing that you could potentially do, and once again, I talked to an accountant about this, figure out exactly what you're doing. One thing that people do is they use this transition to retirement account. So you're eligible for a transition to retirement account once you hit your preservation age. Now, people's preservation ages are different depending on when they were born. So once you hit your preservation age, you can set up one of these transition to retirement accounts. But this is for people, this transition to retirement account is for people that are still working. So let's walk through this example that we use for somebody I made up named Jim. Okay, so Jim is a 60-year-old, and Jim is set up, excuse me, a transition to retirement account, and he remains employed. So Jim makes $100,000 a year. He has a marginal tax rate of 34.5%. There is currently, and this of course changes all the time, there's currently a $27,500 concessional cap. So what that means is that's how much money you can save into super if you want. Now, made up of that concessional cap, of course, is the employee contributions. So those are the mandated contributions you're putting in. So Jim makes $100,000 a year. He's putting $10,500 a year in mandatory contributions into super. So what does that leave him? It leaves him $17,000. So he's allowed to legally put $17,000 additional into super. All right, so let's think about what happens with super. So when anybody puts money into super, or most people put money into super, you're taxed at 15% instead of your marginal tax rate. So that's the advantage that he has, right? He's getting taxed at 15%. He's not getting taxed at 34.5%. That's a very good thing. So what Jim's going to do during this transition to retirement account during this period, what Jim is going to do is he's going to max out his super. All right, he's going to put all $27,500 into that, and that generally is raised as it gets indexed going forward. But he's going to put all of that in. So, but he still needs to live, right? He's still working. He still needs to live. So even though he's upped his super contribution significantly, he still wants to maintain that same lifestyle while he's working. So what's he going to do? So to replace that income that he's putting back in, he needs to take money out of super, take money out of this transition to retirement account. And this is actually going to save him money, right? So instead of paying taxes of $5,856, so that is, and sorry for all the numbers, that's 34.5% on 17,000. That's his marginal tax rate on that $17,000. Instead, he's going to put it into super. He's going to pay $2,550 in taxes. All right. So he's saving money. Now, what does he have to do to get back and live the same lifestyle? Well, he needs to take out $11,135 out of super. Why? Because if you set up a transition to retirement account, and there are limits on it, how much money you can put in, you don't get taxed on the money that comes out. So you don't get taxed on that income that you're making in that super. So he doesn't have to take out the full 17,000. He only has to take out 11,135. So what does that mean? So that means that Jim is saving $3,300 in taxes, right? Instead of paying his marginal tax rate, he's paying 15%. So he saves money on taxes, and he's actually contributing more to super every year. So it's a way to build up your super balance. It's a way to lower the amount of taxes that you're paying. Now, there are, of course, caveats on this, some good ones and bad ones. One is this concessional cap. You can actually bring that forward. So they've got a carry forward exemption where if you were not hitting that cap in previous years, you can go back 5 years to look at it, then you can bring those contributions forward, the ones that you didn't make, and make them that year. So there's potential to do this even more. But of course, you need to have balance in your super of $500,000 or less at the end of the previous financial year. So that's one thing to think about. Super. We've got this nice little diagram, but I don't know. I like details. So I put details in there. The other thing that's really important to think about, and once again, I don't know if it's anybody on this webinar that is doing this, but we talked about that transition to retirement account. But we also need to think about, okay, once we've actually retired, once we have retired, how do we get money out of super? And I just wanted to include this stat because I thought it was pretty interesting. But it's when you go from accumulation to pension, right? At the end of the day, you may not be able to get all your money into that pension, depending upon how much you have. But there's this interesting stat in First Links, which I thought I would share. So there are 2.6 million super accounts where the member was 65 or over. And of those, only 1.4 million are pension accounts. There's 1.5 million people where the member was between 60 and 64. 250,000 of those were pension accounts. So there are Australians out there that are not setting up pension accounts. Now, why is that a bad thing? Well, the bad thing is that if your money sits in the accumulation account, you're paying taxes on it. If it moves into the pension account, you're not paying taxes on it. So it's important to set up an account-based pension, a pension account in your super once you've met these conditions of release. So, and then we listed the three most common ones. One, you retire after hitting this preservation age. Once again, that preservation age can shift based on when you were born. You hit 65 or you are incapacitated. So yeah, something important that I didn't want to put in there because, and once again, like obviously with anything super, anything tax related, you should of course go out and seek out advice. This is just an overview of a couple of potential avenues to go explore. But yeah, something pretty important because there clearly seem to be a lot of people. We don't know the situation, obviously, of every single one of these people, but there clearly seem to be a lot of people that have not done this, have not set up a pension, and therefore are missing out on a tax reduction. So something to think about. All right, so we've got a question. All right, so the anonymous attendee says, should I put my severance pay into my super fund? So of course, that is very difficult for me to answer, and that I think would 100% fall within the personal advice provisions. So I can't answer that, but I will say that that yeah, go look at the tax situation that you have. So Stephen's saying those people are still working, so they're super still in accumulation. Like maybe, right? We don't know. Like there's certainly a possibility that those people are still working. It just seems like a lot. I don't know. It seems like a lot of accounts. And it was just something that we don't know, right? We don't know the individual circumstances of any of those people that are above 65 and do not have a pension account. We don't know why there's such a large gap. But the point of this, regardless, is that you should, of course, make sure you understand the super rules and make sure that you are able to minimize your taxes. All right. Are we out of questions and comments? It seems that way. So anyway, listen, if anyone wants a copy of either the webinar we did on the 4% rule, I think it was a good one. I think it was one of the nighttime ones where I used to drink wine during them. So if anybody wants a copy of that webinar or wants a copy of this report that Shani wrote up, then certainly just reach out to me, mark.lamonica1@morningstar.com. So what Shani basically did, she did a really fantastic job on it. She took this 4% rule study that we did and then put an Australian context on it. So obviously included things like super, included things like the age pension and how you should think about it. But it really goes through in detail if you're really interested in retirement. It goes through all these different scenarios around sort of different withdrawal methods, fixed and floating, et cetera. So anyway, shoot me an email if you want. Yeah, thank you guys very much. So we'll be back in the same odd room on Thursday for our next session.